The simple model for setting interest rates suggests that the Fed funds rate should be at 11% today, not 0.3%. How could the Fed be so dumb?
Welcome back to Breakout with Breaking Views, brought to you by PGIM. I'm Peter Thalassen, the acting global editor of Breaking Views, coming to you from London's Canary Wharf. I'm speaking once again to Edward Chancellor in his book Line Study in the British Countryside. Eddie, welcome back. We're talking this week about inflation and particularly what causes rising prices. It's obviously a very topical subject. Consumer prices in the US in March were 8.5% higher than a year earlier. Yet the Fed has only just started raising interest rates. You have two possible theories for why the Fed is so far behind the curve when it comes to controlling inflation. Tell us what they are.
Well, I mean, just to start, as you say, inflation is running at 8.5%. The simple model for setting interest rates, known as the Taylor rule after John Taylor at Stanford University, suggests that the Fed funds rate should be at 11% today, not 0.3%. Larry Summers, the former Treasury Secretary, Harvard economist, is saying that the Fed needs to raise rates pretty rapidly owing to the tight labor market. Monetarist economists like Tim Congdon expecting double-digit inflation in the near future. So one looks at it and says, hang on, there's a big gap between 11% and 0.3%. How could the Fed be so dumb? And I'm thinking, well, they may be dumb from a sort of economic model perspective, but there are practical realities that are influencing their behavior. And I identified two different sets of realities, if you will. First of all is the stuff we write about the whole time, which is that in the era of low interest rates we've been through for the last 14 years or so, a huge amount of debt has accumulated. US government debt is at a post-war high. US corporate debt is over 80% of GDP, close to its all-time high. You've got a huge amount of foreign dollar-denominated borrowing, mostly from emerging markets, which the BIS estimates at around 13 trillion. You've also got, as I write about endlessly, massively inflated US stock valuations and highly inflated.
So you're saying the Fed is basically worried about a financial crisis?
I think the Fed is worried about a financial crisis because from a sort of economics perspective, they're in a position of disequilibrium. They're damned if they do and damned if they don't. So sort of easier not to do it because they don't want to really be blamed for triggering another financial crisis. Better to have a different sort of problem on your hand.
But then you have another theory.
Yes, this is a more complicated theory, idea, if you will. Namely that Milton Friedman and the monetarist economists, they say, inflation is always and everywhere a monetary phenomenon. In other words, the money supply grows too fast. Well, frankly, any idiot can see that. What the economists don't answer is why was the money supply growing so fast in the previous inflations? And the economists, don't have an answer to that. It's not in their model. But the sociologists do. The sociologists say, hang on a sec, inflation appears in societies that are riven with social and what we call distributional conflicts. You have powerful actors, rent-seeking lobbies, vested interests, so on, and they're all fighting out, and they create a type of sort of paralysis in the state. And when the state is paralyzed, it's unable to raise the taxes and pursue the monetary policies that is necessary to keep inflation under control. Or another way of putting it is this, is that imagine you've got these powerful vested interests. In the 1970s, it was, typically the powerful labor unions, and they all want a larger slice of the pie, but the pie is no longer growing. So the easiest way for the authorities to deal with this distributional conflict is actually to inflate the size of the pie. And you see that time again, from I'd say the French inflation and revolution in France in the 1790s through to the German Weimar hyperinflation of the 1920s.
So people would say, well, those were particular periods of time. I mean, are things in the US or in other parts of the world really so bad at the moment that inflation is the only way to solve these problems?
Well, I mean, I'm not saying that the US is as bad as Weimar Republic, but because that was pretty basket case. But I mean, you look at the US today. You've got these endless culture wars. You've got people. You've got gridlock in Parliament. In Washington with very rare that a party is actually controlling both sides of or both houses of Congress, and you've got powerful vested interests and particularly sort of big tech, big pharma, big banks, and so on. So you've got a situation where it's very difficult to raise the taxes necessary to get things in order, and you've got, as I say, massive distributional inequalities of wealth and income, and there's a lobby in America for high asset prices, and high asset prices don't stay high if you jack up interest rates.
If we bring this all back to then what this means for investors, because I mean, I was checking just before I started this conversation with you. I mean, the yield on 10-year US Treasury bonds is still less than 3%. So why is it that the markets appear to be so relaxed about this inflation at the moment?
Well, I mean, there are two reasons. The short reason is that the market, some bond investors may be expecting things to crash fairly quickly, in which case you could have a shift from an inflation to a deflation environment. My view is that wouldn't be the end of the story. And it certainly wouldn't justify the stock market being at its current level. I think that probably the simplest answer, or most likely answer, is that after long bull markets, there is this sort of wily coyote moment when the investors run off the edge of a cliff and they fail to see that there's no ground under their feet. And I mean, you could see them doing that in 2007, 2008. The stock market, if you remember, hit a peak. US stock market hit a peak in October 2007. That was after the problems arose at Bear Stearns. So in my view, it's really a sort of reflex of the of Wall Street to think that the Fed will come to their rescue and that perhaps the inflation problems will dissipate.
Well, okay, I guess we will be watching those US CPI numbers closely to see whether things keep going up and what the Fed does about it. Eddie, as always, very good to talk to you, and look forward to chatting again soon.